So yeah, oh yeah. Before I move on, I'd like to talk about the story about Huang Qi. So Huang Qi was a legendary, but most of the people in Taiwan doesn't recognize him because he tried to be. He doesn't like to be to brag about himself. And he was a professor at MIT, and he was the advisor of our Professor Chen Qimei when he was at MIT. So Huang Qi was a legendary, and he's also he's definitely academian material, yeah, 院士等级的人. Yeah, he's very cool. I think like if you guys are interested in trading, you can Google his name and learn about his story. So okay, yeah, it's kind of funny, but the textbook pump up this small subsection to discuss about the types of orders. Though I think it's not necessary something about options or futures, but I think yeah, it's something nice to know about. And according to my experience last year, it turns out that many people, I thought everyone already know all this stuff, but it turns out that a big proportion of people doesn't really understand about the ideas about different types of orders. It was meant to be taught at some kind of market microstructure class, 市场为结构的课程. But yeah, let's discuss about these kind of markets. Just to be sure, these kind of this knowledge, these notions about different types of orders does not just suit for futures or options. It actually suits for all kind of trading, financial assets trading markets. So to begin, I would like to show you guys quotes. Say, yeah, just think about the stock or any kind of financial assets that has an open market. Say we have some kind of financial assets. And then for this underlying, we are going to see two columns. A column is called, the first column is called the ask price, and this column is called the bid price. And you should know that when you want to buy these assets from the person or the institution that provide these quotes, you are buying from the ask price, from the top of the ask price. And when you are selling, you're selling to this institution or person at the bid price. And then when you are buying, you begin to buy at the top. When you buy or sell, you begin to buy or sell at the price at the top rows. So what it means is that when there's an institution or broker provides this table to you, it means that, and then the first type of order, the most obvious type of order you can issue is called market order. In Mandarin, it's called 市价单. What it means is that you can buy at this provided price, $10.1, or you can sell to, if you happen to have these assets, say it's a stock, then you can sell this stock to the broker at the price of $9.9. And what is in between this $10.1 and $9.9, this $0.2 is what people call a bid-ask spread. And this is where the broker firms make money out, make profits. Say when we, so yeah, assume, and usually it will come with another column, which is the quantities. Say we have 10 shares, we have 20 shares over here. If you want to, when people issue a market order, basically people do not specify the price. They just specify whether or not they are buying or they're selling and for what quantity. Assume that you want to buy 15 shares of the stock. What happens is that if you issue a 15 shares of market order, you will first exhaust all the 10 shares in the first column. You'll buy 10 shares using under the price of $10.1 per share. Then you'll buy another additional 5 shares using the price of $10.2, resulting in an average price of 10.166667. So something like that. That is what people mean when they issue a market order. When people use market order, you do not specify the price. You specify the quantity and whether or not you want to buy or sell. On the other hand, the second most obvious type of order people can issue is called limit order. And in Taiwan, the stock market in Taiwan, for a long time, there is no market order and there is only limit orders. The limit orders in Mandarin is called 限价单. for limit orders, people need to specify not only the quantity they want to buy or sell, but also for what price. The difference is that when people issue a market order, there's a guarantee that the trade will definitely take place. But then when people issue a limit order, there's no guarantee that your order will be executed. So what it means is that, so now if you want to buy, you definitely want to buy at a better price, right? You want to buy at a lower price. So you may issue a limit order, and then the broker will place your order on the bid side for people. When you want to buy, when you want to buy, your order will be placed at the bid column, waiting for people to sell to you. Say you want to place a very aggressive order. I want to buy 10 shares of the stock at the price of $9. See, the bid price now is $10. You're placing an order of $9. You want to buy at a very low price. That's a very aggressive order. What it happens is that your $9 will go here, below all these bid prices. Because when people want to sell, they will begin, when people issue a sell market order, they will first sell at a higher price, which is placed by previous people or the broker firms. So then they will be selling at a higher price. And then your trade will only be executed once all these orders are exhausted. At the end, you'll be waiting until your $9 limit orders jump up to here. And then people will suddenly decided to sell, may or may not decided to sell you this stock for 10 shares at the price of $9. So there's also another, there's a reason why there's only limit orders in Taiwanese stock market for a long time, for long periods. So according to the microstructure literature, people usually say that market orders are liquidity consumers, and then limit orders are liquidity providers. You can see why, because when the market orders are placed, they basically take away all these kind of quotes. But then when limit orders are placed, they are new entries on these on the quoting books. That is the idea about market orders and limit orders. They are the most obvious and most common two types of orders. Now let's move on to stop orders. What does stop order means? Stop order are basically some kind of orders that exist for people to prevent from a very downside risk. Say, according to the book, if the book looks like this, if you happen to hold a stock, you have like 10 shares, 20 shares of this stock, and you may want to hold it for some good reasons. You may be a shareholder with goodwill, or you may basically just look up to the prospect of this company. But then you want to prevent some downside risk. So you could place what we call a stop order for $8. Say you want to stop sell at $8. What it happens is that before the price hit $8, you will just hold your stock for good. But then once the price drop, and suddenly hit the level of $8, this stop order, this stop sell order will directly translate into a market sell order, and then it will just sell away. So that is actually a preventing mechanism, preventing yourself from suffering with a very extreme low price of the things that you are holding. That's the idea about stop loss orders. Instead of stop orders, one could also place what we call a stop limit orders. What it means is that previously, when I say stop orders, it is by the time when the price is hit, it changes into a market orders. But you could also make it change into what we consider a limit order. So then in that situation, that would be a stop limit orders. Say you could, and then the funny part is that when you want to, by the time you want to place a stop limit order, you need to specify two prices. The first price is the price that will trigger the mechanism. The second price is what type of trade, what is the limit price that it would translate into. Say we could set up a stop limit buy order of a stop price at say $11, and then it will end with a limit price of say $11.5. So if we just wait and wait and wait, if you place this order, it will just stay there and let's wait. If the price hit the level of $11, your order will change into an $11.5 buy order, and then it will just it would actually be quite aggressive because you know that when we are placing a limit order with a very high price, it's most likely that it will be executed right away. That's the idea about stop limit orders. It's a combination between stop orders and limit orders. Market if touched orders, or what people call MIT orders, is very much alike stop orders, but in most kind of cases, it is used as a buy order. So it's very similar. It's almost the same as stop orders, but in the sense that it's whenever a price is touched, it will also change into a market order. Sometimes people just consider it another name of stop orders, but people usually use market if touched orders when they are trying to anticipate buying activities. So that's usually the case. So they are very similar, but people when in most kind of cases when people use stop orders, they're referring to a stop loss order when they are trying to anticipate when to sell. And market if touch orders are the situation where people are anticipating when to buy. So what is market if touch orders? It is saying you are issuing a market if touch an MIT buy order at the price of say $8. It would follow exactly the same logic. When the price dropped to $8, it would change into a market buy orders, and then it would be executed right away. The interesting thing about market if touch order is that even if you the difference between it and also the limit order is that when you issue a market if touched buy order at the price of $8, you do not necessarily buy at $8. It could be slightly higher than $8 or slightly lower than $8, depending on the market circumstances. By the time this price is hit. When do people use market touch orders? It is usually used when people thought that they could perfectly anticipate when the bottom point is. Say you are imagining you are trying to buy, but you don't want to buy right away. You want to buy at the bottom price. You expect that the price would drop, and you expect that the bottom point would be somewhere around $8. Then it's a very good mechanism for people to use when they are thinking about buying at around the bottom points. That's the idea about market if touch orders, time of day orders, open orders, fill or kill orders. The rest three are pretty similar in the sense that they are not defining on the price that whether it would be bought or it would be sold. It's basically they're defining the time horizons when this order will be valid. A time of day order could be that you could specify a time period within a day, say 2 p.m. to 4 p.m. that you want the order to be executed. Otherwise, it will be killed. Open order are basically just the most obvious type of orders nowadays. Say if you are buying or selling things on Robinhood. Do you guys know Robinhood? So Robinhood is the zero commission fee trading platform that's very popular in the US nowadays. Almost all retail traders are using Robinhood in the US. So the default of the orders on Robinhood is basically open orders. What it means is that it will be only valid till the end of the day, till the closing time, the market closing time of the day. If you do not specify, your orders will most likely be an open order. If you want to set it differently, like you want it to stay alive until next day or afterwards until your trade is really executed, then you have to set up the different default otherwise. Fill or kill orders are very aggressive orders. It basically means that it's very much like market order, but that in the sense that it will be, if it was traded, if it would execute it, it would be executed right away. But the difference is that if it doesn't execute it right away, your order will just die out. That's basically what we mean by fill or kill orders. So yeah, so these kind of things are not necessarily a very special notion for futures markets. But then the reason why I think Zhang Ho decided to introduce a lot of variations of these orders here is probably because when people are buying or selling stocks or more direct equity or bond instruments, usually people do not use very sophisticated or aggressive orders. But then in the futures market, you actually see a lot of these different variations of orders. So yeah, I think it's something cool to know about the idea about orders when we are learning futures products. Okay, yeah, we're almost at the end. Here, this is a summary table for from the textbook that talks about the difference between forwards and futures. Let's just quickly go through it once again. Futures, they are mostly traded on exchanges. Forwards, usually it's a private contract between two parties. When we talk about futures products, they are usually more standardized, while forwards are less standardized. And then when we look at futures, there's usually a wide range of delivery dates. You can see for gold, they could have a gold futures maturing in 1 month, 3 months, 6 months, a year, 2 years, 3 years. And it's not that popular when we are looking at forwards. And one very big difference in futures is that there's daily settlement, but then for forwards, it's usually settled at the end of the contracts. And when we look at futures, most of the people will close out before the maturity. And because of the existence of these exchange that act as a central party, there's virtually no credit risk when we are trading futures products, which, well, on the other hand, for forwards, that's not the case. Okay. So yeah, before we finish this chapter, let's think about one very interesting thought experiment. Assume that we have one forward product, one forward contract and one futures contract. They are defined on the same underlying for the same quantity and have the same maturity date. Which one would you prefer? I think that's a very interesting thing to think about when you are comparing these two contracts. The most obvious thing people should first think about is whether or not there's credit risk, because usually when there's more credit risk, it's less favorable for the traders because you do not want to the counterparties to default when you are winning. If that's the case, it's less likely that an asset and contract is favored. So that's the first order thing to consider about. But then let's make some very extreme assumptions. Assume there is also no credit risk at all. If that's the case, what is the remaining difference between the two contracts? There is something still that's triggering in futures, which is called daily settlement. When we think about daily settlement, there is something that we need to consider about, which is your borrowing cost, the opportunity cost of your money, of your balance. That's something you need to consider about. Assume that the interest rate is also fixed, then there's almost virtually no difference at all. But then assume that the interest rate is fluctuating, and there is some correlation between the movement of interest rate and also the futures price. Then things get very interesting. Assume that there's a positive correlation between interest rate and also the futures price. In that situation, futures should actually be preferred to forwards. Can you guys tell why? Okay. Yeah, I'll just give you guys the answer. You can think about it once again when you get home. So the reason why it will be more favored, the price of the futures will be higher than the forwards under such situation is because let's consider if there's an increase in the futures price and you are the long side, what happens directly to you is that there's an appreciation, there's an increase, there's a gain in your margins account. But even when the price is going down, as long as there is a positive correlation between the interest rate and the futures price, even when the futures price goes down, even when it's the time that you receive a marginal call, the borrowing costs then would be actually quite low. Assume that there's a positive correlation between interest rate and futures price. When futures price goes down, and also at the same time, if interest rate also goes down, the borrowing cost is much lower, and it's actually not so hard for you to top up your margin, your margins account. On the other hand, if you think about the short side, if we are the short side, and if the futures price increases, they not only incur a loss, but also at the same time, they when they receive the marginal call, they actually have to borrow at a higher borrowing cost. On the other hand, even when they are the price decrease, the borrowing cost was much lower. So it's nothing. So it's a favorable situation. It's a comparatively favorable situation for the long side comparing to the short side. That's the reason why comparatively the price of the futures will be actually higher comparing to the same forward with no daily settlement at all. So I think, yeah, that's a very interesting to think about. I think it's not from the textbook in this chapter, but I think it's something cool to think about. Okay. Yeah, so this is usually the way I like to do when we have a relatively shorter chapter to cover. I usually just go through some of the practice questions together. Later on, I think next week, I assume when we finish chapter 4, I will also assign the first assignment where it is also consists of the chapter end questions from chapter 1 to chapter 4, so that you guys can do the practice together. So first, let's do these two questions together. This is the practice question 2.33 at the end of chapter 2. So first, explain what it means by open interest. Second, why does the open interest usually decline during the months preceding the delivery month? Third, now this is the calculation question. On a particular day, there were 2,000 trades in a particular futures contract. This means that there were 2,000 buyers going long and 2,000 sellers going short. Of the 2,000 buyers, 1,400 were closing out positions and 600 were entering into new positions. Of the 2,000 sellers, 1,200 were closing out positions and 800 were entering into new positions. What is the impact of the day's trading on open interest? Do you guys want to try it? I can give you guys a minute to think about it. Guys, okay? Yeah, let's do it together, okay? I think, yeah, you can think about it while I'm just explaining, because afterwards you can still just check the answer page. So on the next page, I provide the answer to the previous questions. So first, open interest is the number of contract outstanding. That's basically just the definition. Many traders close out their positions just before the delivery month is reached. That is the reason why open interest declined during the months preceding the delivery months. You can also see a similar pattern previously when I was showing you guys the trading volume. The trading volume also, on the other, no, so not similar, the opposite pattern. When it's closer to maturity, there's actually much more trading volumes, while there's less trading volumes when the maturity date is much distant. So lastly, the calculation questions. Yeah, I think this is a very interesting question in the sense that people might not understand it at first glance. So there were 2,000 trades. There were 2,000 longing positions and there were 2,000 short positions. But among the 2,000 long positions, only 1,400 were among the 2,000 buyers, 1,400 were closing out positions. What does it mean? It means that these 1,400 positions were previously short positions, and now these people are buying to close out their previous positions. So there were 1,400 short positions that disappeared, that are closed out. On the other hand, if we look at the 2,000 sellers, there were 800 new positions. So at the same day, there were 1,400 short position closed, but at the same time, there were 800 short position created. At the end, the open interest should decrease by 600. You can also check on the different, on the opposite directions. Among the 2,000 sellers, 1,200 were closing out positions. So they were closing out their existing long positions. So long positions decreased by 1,200 contracts. On the other hand, there were 600 new long positions. So long position also decreased by 1,200 and then increased by 600. Together, that's also a decrease of 600 positions. So there's a decrease in 600 contract positions in the open interest. The two numbers should definitely meet. Either you look from the long side or if you look from the short side. So yeah, I think this is a cool question to think about. Now let's check another question. This is question 2.34. This is about the balance one. So yeah, you can see that when I'm trying to do the practice questions, I usually like to let you guys do calculations so that you have a better idea how these numbers or questions can be operated. In this question, a company enters into a short futures contract to sell 5,000 bushels of wheat for 750 cents per bushel. The initial margin is $3,000 and the maintenance margin is $2,000. What price change would lead to a margin call? Under what circumstances could $1,500 be withdrawn from the margin account? So yeah, let's think about it. Yeah, let's do it together, okay? So yeah, I think I'm when I was answering one of you guys' questions, I think I made a mistake in the last class. I think by the time when we are withdrawing, you cannot withdraw to make your account below your initial margin. I think that's the case. Yeah, let me correct it over here. So now let's take a look at this questions one together. There is a margin call because the initial margin was $3,000 and maintenance margin was $2,000. There would be a margin call when you experience a $1,000 loss. So we are now in a short positions. When do we incur a loss? We incur a loss when the price increase. The price is 750 cents per bushel right now, and we are to sell 5,000 bushels. And what kind of price change would lead to a $1,000 decrease when we are to sell 5,000 bushels of wheat? The answer is that if the wheat futures increase by 20 cents per bushel, then say from 750 to 770, then there will be a 20 cents loss for each bushel, and then 20 cents or $0.2 multiplied by 5,000 units would lead to exactly a $1,000 loss. So if the price increased by 20 cents, we will receive a margin call. On the other hand, for $1,500 to be withdrawn, we need to have a gain of $1,500. $1,500 decreased by divided by 5,000 bushel leads to 30 cents or $0.3 or 30 cents change in the price. What direction should the price be changing towards? It should be a 30 cents decrease because we are to sell. So decrease in the price is more favorable. Okay. So yeah, that's the two questions I would like to go through together for chapter 2. Okay, is that clear to you guys? Yes. See, okay, no problem. Yeah. So let's think about it. Every condition is similar for the forwards and also for the futures, except that when we are trading a futures contract, there will be daily settlement. What bothers us about daily settlement? What bothers us is the borrowing cost of your money deposit in the brokerage firms. So if the borrowing cost, so if you think about a positive correlation between interest rate and futures price, when there's a positive correlation, and think of yourself as the long side of this futures contracts. When the future price increase, it's something you would favor for, because then you will have a gain from the daily settlements. On the other hand, when there's a decrease in the futures price, what's not so ignoring to you would be that there is also a decrease in the interest rate. Had there been a real positive correlation between the two? What does a low interest rate mean? It means that your borrowing cost would also be lower, so it's easier for you to fill up the margin costs. On the other hand, if you think about yourself as a short side, then if the price has an increase, you are going to experience something very disappointing. The price increase, you are going to, you have a loss in your margin account, and by the time you hit your margin call, when you are to borrow more money to fill up your gap, you're going to see that the interest rate is also much higher. So it's more, there's more advantage for the long side comparing to the short side. That's the reason why comparing to a neutral benchmark, which is maybe a forward contract, this kind of futures contract would actually have a relatively higher price, maybe just by a very few pennies. But still, that's the idea about this idea why we should be focusing on the correlation between interest rate and also the futures price when we are to compare futures price and forward price under OLC both situation. Okay. Okay. Yeah, that's about chapter 2. I actually don't like chapter 2 that much. Yeah, because it's so tedious. But yeah, let's focus on chapter 3. Chapter 3 is much more interesting because now we're going to deal with real trading strategies. Let's think about trading strategies, what we can do using futures. In this chapter, we will be entirely focusing on hedging strategies, trying to hedge some kind of risk that we are unwilling to experience. And also, we're going to do the most simple type of hedging strategies, which is what we call a hedge and forget strategy. It's something like buy and hold. It's just that when you establish this position, you just live with it. You just stop balancing, stop adjusting your portfolios. That is what we mean by hedge and forget strategy. You just set up for it and then wait for things to happen. You do not adjust it from time to time. That's what we mean over here. The most basic and most straightforward type of hedging strategies. And the most obvious one, the simplest way to do the hedging strategy using futures is basically a long hedge or a short hedge. A long futures hedge is appropriate when you know you will purchase an asset in the future and want to lock into the price. So yeah, you know you want to buy something in the future and you are unwilling to take up the uncertainty of the price fluctuation in the spot price. Then probably it's very favorable for you to do a long futures hedge. It's also the case for short futures hedge. So now let's take one example and you'll see what it means. Assume we are standing at the time point of May 15th, and we are to look at a short hedge. A crude oil producer is to sell 1 million barrels at market. Because each contract size is on. Yeah, so yeah, we do not talk about contract size over here because we are going to sell 1 million barrels. So when there's each increase or decrease in the price per barrel, you're going to gain or lose $10,000 because this oil producer is to sell such a large amount of crude oil. So then it's pretty reasonable for him or for her to set up this hedge. On May 15th, the spot price was $80 per barrel. Futures on August 15th is $79 per barrel one contract for 1,000 barrels. So now what we're going to do over here is very simple, the most straightforward type of hedging. We are basically just standing into a short position to lock into a price to sell in 3 months. That's basically what this crude oil producer is trying to do. He hedged by shorting 1,000 contracts, lock into the price to sell 1 million barrels of crude oils. Something interesting is that always remember, we try to close out our positions, whether or not you are to conduct any kind of, whether or not you are to sell or not to sell this physical commodities. We'll talk about that very shortly, but then the very short answer is because the delivery comparing to selling it at the spot market is actually much more costly. So what happens over here is that let's consider two situations. One situation is when the spot price decreased to $75 on August 15th. And let's consider another situation where the spot price increased to $85 on August 15th. Yeah, one increased situation and one situation for the decrease in price. What about chapter 2? What we mentioned is that the futures price right before or very close to the maturity date should be very close to the spot price because the two converge with each other. But by then, the futures price on the August 15th, that will also mature on August 15th, will be almost exactly the same as the spot price. So now, if our crude oil producer decided to hedge by going into a short position on May, but also close out on August 15th, and then sell his crude oil at the spot market, what happens is that he's going to experience a gain of $4 from this futures trade. But at the same time, he's going to sell each barrel of crude oils for $75. Again, it's similar to selling at $79. This is also the case if you look at the situation where one goes, if the spot price goes to $85, this crude oil producer will experience a loss of dollars according to his futures trade experience, and then sell it for $85 at spot market, and that's still basically it's similar to locking into the price of $79. Some of you may ask me, it seems quite redundant to close out on August 15th. The reality is that by doing so, it's actually less redundant. The reality is if you are to run through all the delivery process, it's actually much more time consuming, also much more costly physical. So it's easier for one to close out their position and then clear his position on the exchange on the futures market, but then at the same time conduct the trade on the spot market. Still, it has exactly the same results as if one is. Any questions so far? Yes. The payoff. So when we lock into, so take a look at this $75. What it happens, what it means is that when this person decided to sell, decided to enter this position, this futures position, he or she are in a short position to sell at $79. And by the time he or she closed out the position, the futures price was $75. So think about the maintenance balance, all the daily settlement. Once again, the collective result was that he's going to earn $4 per barrel, according to his initiating of this futures position and then closing of this positions. He earned $4 by entering into a short position and then exiting these positions afterwards, sometime very close to August 15th. But at the same time, he or she can also sell the crude oils at the spot price for $75. That's the reason why it's almost exactly the same as locking into the $79 futures markets price at May 15th. When does this contract happen? What do you mean by happen? Yeah, and we are thinking about hypothetical situations on August 15th. We are standing at May 15th, and we are considering two possible situations. Just think about the situation when you really let the delivery happen and assume that it's costless to let the delivery to take place. Then basically you are selling at $79, right? On August 15th. Right. Why? Assume it's perfectly costless to make the delivery happen. The crude oil producer is now in a short position to sell at $79 on August 15th and assume that he or she does not close out the position. Then he or she are just basically selling at $79, right? So he's collecting $79 per barrel. Now it's just exactly the same. It's just that in reality, delivery is very costly. You need to set up an arrangement with your counterparties, and then there may be some kind of frictions on the road. It may be hard to really hard comparing to selling it on an open market or for the spot for the current crude oil. So he or she decided to close out right before the maturity date, say few minutes, a few hours before the maturity date, because by then the futures price would be $75. So now let's forget about selling it. Let's just think about a situation where you are managing on the futures market. You enter a short position at a price of $79, and then you close out your position at a price of $75. You agree to sell at $79, but then you close it at $75. So you have a gain of 79 minus 75, which is $4 from the futures trade. At the same time, our crude oil producer decide to sell on the spot market. It's $75, so then basically we just add back the $75 and get $79. That is basically the same as if we do not close out. But in reality, this is much cheaper comparing to letting the delivery take place. Does that make sense? Yes. You guys need me to explain once again? Okay, yeah, let me try it once again. Think of a situation where the delivery really takes place. The delivery really takes place. So our crude oil producer is selling at $79. He or she will collect $79 for each barrel of crude oil that he or she is selling. However, in reality, it's very costly to let the delivery take place, because you need to arrange with your counterparty to set up a deal, to set up a place to let the trade take place. Well, on the other hand, it's much more costless to sell in the on the spot market, because there's an open market for crude oil at spot. So he or she is conventionally the case in most. This is the most conventional case. People usually close out their positions right before the maturity. So this person decided to close this position right before maturity, but very close to the time of maturity. So what do we mean by close? We enter into a long position of the exact same contract size. By doing so, when the spot price is $75 on August 15th, the futures price has an expiration on August 15th will have a price very, very close to the spot price. So then you can just treat it as equal. So it's $75. That a futures contract that expires on August 15th, when we are standing at the time of August 15th. The short position at the price of $79, we agree to sell at $79. Think about all those cash flows we look at in chapter 2, the maintenance margins, the margin balance. If we close out our position, when we enter a short position at the $79, and when we close out our position at when the price is $75, we actually made a gain on this futures trade. How much is the gain? $4 for each barrel of crude oil. On the other hand, if we close out at the time when the futures price was $85, then we actually close out at a less favorable price and we incur a loss of $6 per barrel. But at the same time, you can also sell the crude oils for $85 per barrel. So it would basically mean the same as if we made the delivery happen. It's just that in reality, it's very costly to make the delivery happen. So people will usually close out right before the maturity. Make sense? Yes. And then sell at 75. That's right. You can take it that way. But it's just that when we are thinking about the trades for on the futures market, technically speaking, there is the first two parts, there's no real trading regarding the underlying assets. But you can think it that way as well. Okay, it would make much more sense later on when we have the numerical examples. Let's just try one more example. Today, we're standing at the time periods of January 15th. A copper fabricator will require 100,000 pounds on May 15th. Yeah, this is the metal situation. On June 15th, the spot is 340 cents, $3.4 per pound. The futures on May 15th is 320 cents per pound. One contract is for 25,000 pounds. So because this person will require 100, she decided to loan 4 contracts. And again, we decided to close out on May 15th. Yeah, let's take a break and then we'll come back and finish these examples. Later on, you'll have a better feeling what we are talking about right now. Okay.